Welcome back to The Explainer. Today, we're diving straight into a professional analyst briefing on Teladoc Health, specifically unpacking their Q1 2026 earnings execution and forward-looking guidance. Look, if you're an institutional stakeholder, an investor, or just someone keeping a close eye on the global virtual care space, you already know Teladoc is right in the middle of a massive, highly complex transitional phase. The whole pandemic-era telehealth boom, yeah, that's in the rearview mirror, and the entire sector is dealing with a pretty harsh reality check. So today, we're going to slice through their consolidated metrics, unpack this crazy divergence happening between their operating segments, and critically evaluate management's roadmap for the rest of the year.
Quick reminder right up front. This video is for educational purposes and not financial advice. We're simply pulling apart the data straight from Teladoc's official earnings reports to help you understand the absolute nuts and bolts of their business. Okay, here's our roadmap for the briefing. We'll be moving through the Q1 2026 financial snapshot, integrated care revenue trends, BetterHelp segment challenges, the CEO's perspective on strategy, the full year 2026 financial outlook, and finally, some strategic takeaways for investors. Let's get to it.
Starting with Section 1, Q1 2026 Financial Snapshot, Navigating the Macro Reality.
So let's anchor this analysis with the top line. For the first quarter of 2026, Teladoc reported consolidated revenue of $613.8 million. Now that's a 2% year-over-year decline from Q1 of 2025, but when you look under the hood of that top-line number, things get super interesting. For example, their access fees revenue actually dropped 8% to $484.7 million, but their other revenue jumped 25% to $129.2 million. What's that tell us? It signals a very deliberate evolution in how they monetize. We're also seeing a massive geographical shift. U.S. revenue actually shrank by 6%, but international revenue, it surged 17% to reach $122.3 million. That international momentum is absolutely crucial for investors to watch. It proves they are actively diversifying away from a super crowded U.S. market and grabbing territory where virtual care still has huge room to run.
Pausing here on the bottom line, the net loss for the quarter was $63.8 million, or 36 cents a share. Well, obviously taking a loss isn't the goal for any enterprise, but context is everything, right? This is actually a major improvement compared to the same time last year, when they posted a much steeper $93 million loss. And you have to look at what actually drove the loss this time around. It included almost $90 million in amortization of intangibles, roughly $15 million in stock-based compensation, and $12 million in restructuring costs, mostly severance packages. So what's the big takeaway here? It tells us their underlying cost structure is aggressively normalizing. Unlike last year, when they got hammered by a massive $59 million goodwill impairment hit, this quarter's loss is a lot cleaner. It's totally missing those unpredictable impairment charges that tend to terrify institutional capital.
But here is the real standout metric. Despite the revenue dip and the net loss, adjusted EBITDA showed some serious muscle, staying basically flat year over year at $58.2 million. Think about that for a second. Holding your EBITDA steady while your top line shrinks and you're actively restructuring, that is no small feat. It points to some really ruthless discipline when it comes to cost management and protecting their margins during a very fragile transition. Usually, when revenue slips, margins just evaporate unless management is pulling the exact right levers. But here's the catch. This flat consolidated EBITDA is just a blended average. As we're about to see, it's actually masking a massive tug of war going on beneath the surface between their core business units.
Which brings us to Section 2, Integrated Care Revenue Trends, Steady Enterprise Performance.
So, looking at the integrated care business, which is their B2B enterprise medical services, chronic condition management, all that good stuff, it delivered incredibly solid, predictable results. We're talking a 2% year-over-year revenue bump, hitting $395.4 million for the quarter. Make no mistake, this segment is the rock-solid anchor of Teladoc right now. They closed the quarter with over 101 million U.S. members, and importantly, chronic care enrollment grew 4% to almost 1.2 million people. Plus, the average monthly revenue per U.S. member actually ticked up 2% to $1.30. But the best part? The profitability completely outpaced the revenue growth. Adjusted EBITDA for this segment didn't just grow 2%, it spiked an impressive 12% year-over-year to $56.3 million. This is textbook enterprise scale. It's operating as the cash cow of the whole company, using long-term contracts to pad margins even when member growth is just creeping along.
Now for the other side of the coin. Section 3, BetterHelp segment challenges, the micro divergence.
That enterprise stability we just talked about, it completely sharply contrasts with the brutal headwinds hitting their BetterHelp consumer segment right now. It's honestly like a tale of two completely different businesses. On one hand, Integrated care relies on stable, multi-year contracts locked in with huge health plans and employers. On the other hand, BetterHelp relies almost completely on direct-to-consumer marketing and out-of-pocket spending. And in today's macro environment, where inflation is stubborn and everyday consumers are pinching pennies, that D2C model is getting squeezed hard. Customer acquisition costs are wildly unpredictable, and just keeping users from churning out is becoming a massive daily hurdle.
Just look at this divergence on the screen. It is stunning. Integrated care grew revenue by 2% and held a fantastic 14.2% EBITDA margin. Meanwhile, BetterHelp shrank by 9%, down to $218.4 million, and their margins basically evaporated, down to 0.9%. Let's be real. For an institutional investor, a 0.9% margin on a D2C product is a massive blinking red light. To give you some scale, BetterHelp's adjusted EBITDA fell off a cliff, dropping 75% from $7.7 million last year to under $1.9 million this quarter. That was driven by a 9% drop in paying users. It's just a brutal reminder of how expensive digital ads are right now. When people stop spending, the marketing budget needed to replace them just skyrockets, and your margins go up in smoke.
Moving to Section 4, CEO Perspective on Strategy, Management's Qualitative Context.
So the numbers tell us what happened, but the CEO's commentary tells us how they plan to fix it. CEO Chuck DeVita hit the nail on the head regarding this divergence, saying they're making meaningful progress scaling insurance acceptance in BetterHelp. This is a massive strategic pivot, guys. BetterHelp has always been the king of the out-of-pocket consumer-paid therapy model. By bringing insurance into the mix, they are trying to lower the barrier for regular people and build a much stickier recurring revenue stream. In fact, in Q1, they pulled in $12.9 million just from insurance-covered services, a number that was literally zero at this time last year. But look, transitioning a huge D2C platform into an insurance-backed medical model is incredibly complex. You need totally new billing systems, new credentialing, new marketing, but if they pull it off, it totally rewrites the lifetime value of their users. They go from being short-term spenders to long-term subsidized patients. That is exactly why the smart money is watching this pivot so closely.
Let's look at how this all plays out over the year. Section 5, FY 2026 Financial Outlook, the Future Horizon.
Management reaffirmed their full-year guidance here, targeting revenue between $2.48 and $2.57 billion and adjusted EBITDA between $267 and $306 million. They're also projecting free cash flow generation between $130 and $170 million. For stakeholders, that free cash flow number is everything. It's the absolute lifeblood of this transition. Churning out up to $170 million in free cash gives them the liquidity they desperately need to fund that messy BetterHelp insurance integration and service their debt, all without having to dilute current shareholders. But hitting these targets? That requires absolutely flawless execution of their segment assumptions.
And when we dig into those specific assumptions, you can see management is bracing for BetterHelp to remain in negative territory all year, guiding for a revenue drop somewhere between 1 and 6.5%. Because of that, Integrated Care is being asked to carry the entire margin expansion mandate on its shoulders. They need the enterprise side to grow up to 3.5% and push its EBITDA margin up over 15%. The entire 2026 thesis basically assumes Integrated Care will act as an unshakable cash cow while BetterHelp figures its life out. But we have to ask the hard questions. What if the consumer economy gets worse? What if BetterHelp shrinks by 10% instead of 6.5%? Can Integrated Care really expand fast enough to plug that leak? That is the structural risk baked into this outlook right now.
All right, bringing it home with Section 6, Strategic Takeaways for Investors, Charting the Path Forward.
For institutional investors, here's the bottom line. Any upside here hinges 100% on management's ability to execute with absolutely ruthless discipline. Teladoc has to protect that fortress they've built in Integrated Care at all costs. They have to keep trimming the fat, which we already saw them doing with the $12 million in Q1 restructuring. And most importantly, they have to carefully thread the needle with BetterHelp, rapidly scaling up that insurance acceptance without completely destroying their margins in the process. They need to evolve their clinical model to prove undeniably differentiated value to these massive health plans.
So, we leave you with this final thought. The question isn't whether virtual care is the future. We all know it is. The real question is whether Teladoc can adapt its internal segments fast enough to capture that future profitably. Can they weather the storm and return to sustainable growth? We'll be watching closely. Thank you for joining us for this explainer, and please remember to like and subscribe for more videos.